Hello, in this video we're going to talk about indirect taxes. Indirect taxes are taxes levied on the consumption of goods or services by the government. You can contrast them with direct taxes, which are taxes that individual economic agents, such as individuals or firms, pay directly to the government. For example, individuals might pay income tax or national insurance, which comes out of their income. If you are employed by a firm, then that might come directly out of your income before you've even seen it. If you're a firm, you might pay a direct tax in the form of corporation tax, which is a percentage of a firm's profits. However, we're going to consider indirect tax. There are questions about why governments might impose indirect taxes on the consumptions of goods and services. They might, for instance, simply be attempting to raise revenue so that they can spend money on public goods and merit goods that they think it's worthwhile to provide for society because it will boost or improve economic welfare. On the other hand, they might impose indirect taxes on the consumption of some goods and services that they believe will be overconsumed when left to the free market, namely demerit goods, for example, cigarettes or alcohol, or perhaps petrol. Let's begin by getting a definition of that down. An indirect tax is a tax levied on the consumption of a good or a service. Now, an interesting thing to note is that ultimately an economic agent in the supply chain, so that's a producer or a firm involved in the production of a good, is ultimately responsible for transferring the tax revenue to the government. That's going to become important later when we think about the effects of imposing an indirect tax on demand and supply curves. We're going to see that this indirect tax ultimately acts as a cost of production that has to be taken into account by firms when they're deciding on the quantity of a good or service to produce at any given price. Now, the two most common examples of indirect taxes in the UK are value-added tax, which is a tax of 20% imposed on most goods and services in the UK. There are, however, exceptions. There are goods that the government would like to encourage individual economic agents to consume because they are considered merit goods. For example, children's clothes or books. Fruit and veg is exempt from VAT. The government has charged different VAT rates at different times. After the financial crisis of 2008, value-added tax was reduced to 17.5% in an effort to try and encourage consumption, which, if you've studied macroeconomics, you'll realise is one part of aggregate demand, and aggregate demand had decreased in quite a pronounced way after the financial crisis. So reducing VAT was seen as one way the government could encourage more consumption. The other most common form of indirect in the UK is excise duty. Excise duty is a tax levied on the sale of specific goods, namely demerit goods. These are goods that the government believes will be overconsumed if left to the free market. They could be overconsumed for a couple of reasons. The first is that the market price doesn't take into account any significant negative externalities in consumption. By that I mean the cost to third parties of individuals consuming these goods or services. For instance, cigarettes. The price of a cigarette when left to the free market or a packet of cigarettes might not take into account the fact that further down the line taxpayers may be left out of pocket because of increased NHS care that's required for these smokers. Another reason that demerit goods might be overconsumed when left to the free market is that individuals overestimate the benefits or underestimate the costs of consuming those goods and services. In particular, excise duty is often applied to alcohol, to cigarettes, and to petrol, for instance, because the use of petrol might result in pollution. Now, indirect taxes can be applied by the government in a couple of ways. They can be specific indirect taxes, or they can be ad valorem indirect taxes. Specific indirect taxes are fixed monetary amounts that the government levies on the consumption of one unit of a good or service. For example, it might be that the market price of a good or service is £2, but on each unit of consumption the government levies a tax of 40p. Now, if the market price increased to £3, that incidence of tax for 40p would remain the same. So in the original example, the tax paid would be 40p to the government, and in the second example, it would still be 40p. Now, an ad valorem tax acts in a different way. An ad valorem tax is applied as a percentage of the market price. That means that a 10% tax on consumption of a good or service will be a different rate if the market price is £1 or £2. Namely, in the first example, the ad valorem tax, if it was 10%, would be 10p. If it was £2, the ad valorem tax would be 20p. So, as the market price of the good or service changes, so does the incidence of tax. So let's have a look how the application of a specific indirect tax would affect the decisions of firms to supply a market. To keep things nice and easy, I have left the demand curve off this example, but we will introduce it later on. So imagine, for instance, you've got a good or a service that firms are willing to supply. We'll add a supply curve onto our graph to show this. All the supply curve shows is that all other things being equal, as the price of the good rises in the market, firms are willing to supply a larger amount to the market. That's because as the price rises, firms will cover their costs. They include their fixed costs, their variable costs, but perhaps more importantly, the opportunity cost, the profit that they could have generated by putting their factors of production to use in the production of a different good or service. As the price of this particular good or service rises, then more and more firms begin to have this profit incentive, which means they join this particular market. However, imagine that the government is seeking to raise revenue. So they apply a specific indirect tax to this particular good or service. And let's say that that specific indirect tax is at a rate of 50p per unit. Now, what this means is that at any given price, firms must pay a 50p levy to the government. Essentially, this adds a 50p to the cost of production, whatever the given price. This is indicated by a shift up and left of the supply curve. So let's imagine before the tax is applied. At a price of £1, firms are willing to supply Q1, quantity Q1 to the market. The government applies the specific tax of 50p, and this has the effect of shifting the supply curve up and to the left, and it will run parallel to the original supply curve. This is because at any given price, the incidence of tax, the 50p, remains constant. So the gap between these two lines is 50p. That means that for firms to continue supplying quantity Q1, the price in the market must be £1.50. Of course, an ad valorem indirect tax will produce a different graph, which we'll look at right now. An ad valorem indirect tax is applied in a slightly different way. It's applied as a percentage of the market price rather than as a fixed monetary value. We'll begin again with a standard supply curve. All this demonstrates is that as the price of a good or service rises in the market, then all other things being held equal, particularly the cost of production, firms are willing to supply more of that particular good or service because they are incentivized by the higher profits on offer. Now imagine that in this given market the price was at P1, and at that price firms are willing to supply quantity Q1 to the market. But the government applies an ad valorem indirect tax. Let's imagine, for instance, that it is a 20% tax on the price of a unit. Now, this has the effect of shifting the supply curve upwards and to the left. It's an increase in the costs of production. However, because the rate of tax will change according to, not the rate of tax, sorry, the incidence of tax will change according to the market price, it has the effect of raising the cost of production at a greater rate than S1. So the supply curve rises with a steeper gradient than the original supply curve. Now, what this means is that for firms to continue supplying Q1 quantity of goods and services, the new price is going to have to be up at P2. And the price between P1, the difference, between P1 and P2 is the incidence of tax at that given quantity, at that market price. However, we can imagine a situation in which the market price was actually P3. Now, at P3, because it's higher than P1, firms are willing to supply a greater quantity of that good or service to the market. They're willing to supply Q2. However, with this ad valorem indirect tax of 20%, the incidence of tax levied on the good, on each unit of the good at P3, is going to be a greater amount. 20% of a higher price will be a higher amount than at P1, which means that for firms to continue supplying Q2 to the market, the price is going to have to rise all the way up to P4. Now, the important thing to note here is that the difference between P1 and P2, the incidence of tax in the original situation, is smaller than the difference between P3 and P4. As the price rises, as the market price rises, then the incidence of tax with an ad valorem tax rises as well.